DNA of technical trading. You know, there's a lot of different tools in the market. There's hundreds of indicators and thousands of stocks. So you know, I think often no matter what level of experience a trader is at, it's always a process of how do you take this fire hose of information and you know, reduce it down to something we can manage and duplicate in a profitable way. The topic today, the DNA of technical trading, is all about that. It's how we start to dissect the market into quantifiable pieces that we can then build into a strategy. Of course, towards the end of the presentation, I'd love, depending on how much time we have, I'd love to take questions and start applying this to live stocks and live markets, and actually talk to you about some of the ones we're currently holding. But of course, it's not a recommendation to buy or sell. So the agenda. Well, basically, for those of you who are really advanced traders, I apologize for the basicness of the first part, but the very first part we're going to do is really just define what the market is. And I know that sounds silly, but if we can take a top-down approach to see what the market is, how it works, and what makes it work, well, then we can use that information as almost like a hypothesis to build our strategies from. And that's where things start to get really fun. So we're going to break the market down, and then what we're going to talk about is how the smart money plays a role into this, the different personalities that occur, and how then scans and process-driven checklists then help us to monetize that. And the key word there is process-driven. As traders, if we're going to be serious about this, if we're going to be making money, whether it be for an income or capital growth or both, just like any business, you have to have a strategy. You've got to know exactly what your plan of attack is. What niche do you focus on? What's your marketing budget, and when do you know if it's working, and how much are you willing to lose until you give up on it? These are all things that a trader should have. So I guess the first thing we can chat about on a basic level is what type of investors people are in the group. And if you don't mind sharing that in the Q&A box, it'll just help me to focus some of the examples and trades that we look at towards where the majority of people here are focusing in their trading. And while you do that, I'll tell you a bit about myself. I've been trading now since 2003. We started Acron in 2007, where we started teaching it. But I consider myself mostly a day trader or a swing trader, utilizing options for leverage. But the term I much prefer than day trading or swing trading is target trading. And the term target trading comes from something we're going to talk about later, which is that I believe a stock never changes direction unless it bounces off support or resistance. And those levels can be consistently, clearly defined. So once it bounces off support, it will hit the above resistance unless it breaks support. So whether that takes a minute, an hour, a day, or a week, I'm not too concerned with time, as long as it's not taking too long. I'm mostly looking at the fact of where I see the high probability move to start from and finish, and just let it do its job. Okay, so maybe the more technical question is how people make their decisions. And this is obviously where we start to talk about process-driven, quantifiable methods. How do we find ideas? And once we find ideas, how do we decide if they fit our business plan of trading or not? So is it news? Is it tips from friends? Is it brokers? Is it things we're familiar with? It doesn't matter, but there's so many ways we can get ideas. But then what do we do with the idea? Because we should really have almost, and I do, have an Excel sheet where you go through and see if it fits your formula for success. So if you're looking for a long, what kind of P/E ratio does it have to have? Is it under 20? What type of, is it a momentum trade? Is it an oscillating trade? Is it a, what are the candlesticks doing? Do you care about management or not? And based on the type of trade you're doing, what are the indicators you need to confirm it with? All these types of things formulate the recipe, which is critical for success. Without a recipe, and not just in general gut instinct, but without an exact quantifiable structure of exactly what each decision has in common, you're left with emotional decision making. And that's why most people lose money. They're constantly reevaluating their stock position. And I mean, just a great example. Someone called me yesterday and they said, "Oh, John, I bought this stock that you guys were talking about a couple of weeks ago, and it's up from $1.50 to I think it was like $3 or something." And they said, "I'm not sure if I should sell now or not." And I said, "Well, you're probably at the peak of your emotion right now of greed and fear. What was your plan? Where had you originally planned to sell it when you bought it back at $1.50? And they said, well, I didn't have a plan. And I said, well, then I'm going to help to you, because basically I will never enter a stock without knowing where I'll get in and where I'm getting out and where my stop loss is before that trade's even occurred. And that could be weeks before the trade even reaches my entry point. And you need that, because without emotionless decision making, you'll lose. Why do you think 95% of people do lose? Statistically, that sounds really odd, because if you could just throw darts at a dartboard, or as they say, monkeys throwing darts at a dartboard, and looking for longs, well, you got a 50-50 chance of success, because half of them will go up and half of them could go down. It's a coin flip. So how can 95% of people lose? It's because we're engineered to lose money. We react to the market instead of planning for the market. We respond to news instead of realizing that most of the news is already factored into the price of the stock before the news even comes out, because the smart money already knew about it. So every time you're looking at this, or the talking heads, or all of the different things there are out there to confuse you, that's people lose money. And the market's very, very good at helping you do that. The stock market is the best run business in the world, because the job of the smart money, if they've got $1 billion of Apple and they think that the market's topping, that the last person they're going to tell about that is you. In fact, it's the opposite. They're going to make sure there is as much publicity, as much good stuff going on in their forums, as much good news in the markets and on the news saying, hey, Apple's going higher. And that's exactly their best opportunity to offload it and sell it to you. So that's why we understand how the smart money works, and we'll be getting to that soon. But firstly, some real basic stuff. What kind of market directions we have? Well, we've got up, down, and sideways. Really easy. Up markets, unfortunately, is where most people focus, because it's only 1/3 of the direction, but most people only focus on this. Some people say that, well, I can't trade short because I'm in my IRA or an RSP. Well, that's not true, because you can buy inverse ETFs, so everyone can short the market, and it's a huge portion of where a lot of money is made. This is very evident by the fact I was sitting down, sitting by a pool one day with a guy who was watching me trade and asked me what I was doing, and I said, well, I trade, and he said, oh, you're a trader. Gosh, this must be a really depressing time for you, because the markets were plummeting. And I turned to him and I said, I've made more money in this down market than I made in the previous 2 months when it was rallying. So we need to break away from these types of false perceptions. And sideways markets we can make money in too. Sell in May and go away? Why? Why not set up credit spreads? Why not set up option trades where if a stock goes nowhere, you clean up? As long as it doesn't break higher than a certain level or go lower than a certain level, you're making money while you're on holiday. I guess that's what I'm trying to get across, is that there's a lot of opportunity in the market. And if you understand, if we get away from the emotional side of things and trying to over-intellectualize it, you can make money in all conditions. You just need to understand what tools are right for the job depending on the situation that we're in. And this is where we get to my next point, market personalities. The most common thing that I see people learn when they first get into trading is the typical stuff, right? well, buy a stock when it crosses over the 9-day moving average, or when the 9 and 20-day moving average cross, buy the stock. And and by the way, when that happens, make sure the MACD is positive, and let's look to see that. Let's look to see if the RSI has gone up over 30, and maybe it's close to 50 by now. Okay, great. All of those things are things I also teach, and they can work very, very well if they're being applied to the right type of personality of the stock, which in that example would be momentum. Now go and take those same rules and apply it to an oscillating trade, and I will bet against you every single time, because it doesn't work. What works in oscillating trades is completely black and white to what works in momentum trades. So the three different key personality types in the market is oscillation, firstly, and this is defined by, well, let me take a step back. What we're trying to see when we're looking at the stock market is we're trying to define what the personality is, and the personality is what system of support or resistance controls where the stock goes. Isn't that that's what we ultimately need to know, right? To trade, we need to know when the stock's going to change direction. To do that, we need to know what the powerful forces are that create that effect, which is when does buying overweigh selling and vice versa. So when you first look at a stock, your most important job is to look at the, say, last 6 to 12 months and say, why did it change direction? What did it hit? And you should go through, and through moving averages, horizontals, and trend lines, map up that chart so that you've been able to effectively explain why the stock changed direction every time. And once you've done that, you're going to start to see what type of personality the stock is in. So on the left-hand side, the reason that the stock changed direction every time was because it hit one of 3 static, straight lines. Okay? Now, basically, what we then do is we can say, well, what about when that changes? What if it breaks that? Well, now we've got a new potential personality. And in this situation, we go into consolidation. Now, consolidation is a type of oscillation because it still bounces between 2 straight lines, but the difference is that it doesn't really have a trend. It's sideways. And some people would argue that because it's consolidating, because there is no trend, that it's therefore a flip of the coin as to where which way it's going to break out. That's not true either. And some of my best trades have been on consolidations that have broken out that were highly predictable. Again, we'll talk about that later when we get into some of the technicals and the smart money stuff. But the third type of personality is momentum. And momentum, it will still be affected by these horizontal lines and so forth, but because the predominant powerful force behind the stock is not the horizontals or the trend lines, because the powerful force behind the stock is the moving average behind it, that will overpower the horizontal resistance, therefore breaking new highs, therefore being momentum that you can hang on to. So totally different. And knowing the difference between the 3 is critical if you're not going to consistently get short double tops that end up breaking out, or going long on breakouts that end up reversing. These are key problems that happen when you don't understand the differences. So I'm going to do this now and start talking about how you can see where these resistances are. All right. Someone says, target sounds like a stock stalker versus a swinger. Well, yeah, absolutely. I think it's a great analogy, actually. You do stalk stocks. What you basically want to be doing when you're looking at a chart is looking for the best possible point that you could trade it and just waiting and waiting. And that could be 3 months until you get that ideal entry point. But you stalk it. You're hidden in the bushes waiting for that weakness or the inefficiency in the market where you can tag that trade and take it home. All right? So let's go back to the slides. So the Stock Stalker webinar, hey? As we start to get through these definitions and we start to see, where we're, what kind of systems are in control, then we need to start to decide which of these systems, which of these strategies we want to specialize in. Now, in the stock market, there are approximately 60 common patterns that exist. And these, each of them has their own probability of success. So out of 100, how many of them go up, how many of them go down once you've located the pattern, how much profitability there is, so how much will they generally go up by in a winning trade, and how much do you have to lose to know it's one to let go of, or in other words, draw down or losses. Okay, now the final thing is predictability. So just because you found the best strategy in the world, if it takes you 9 hours a day to find a stock that's in that pattern, to me that's not worth the extra profitability if I can find a less profitable trade in 10 minutes. So, because your time is worth something as well. So out of all of these 60 patterns that are broken down into either consolidation, momentum, or oscillation, which do you trade? And what exactly are you looking for? So what do the candlesticks do? When you're buying the trade, what do the last 5 candles look like? Are they expanding in range, contracting in range? Are they closing at the top of the range or at the bottom? Is volume increasing or decreasing? What is the minimum volume? And has it broken above the 20-day average? What type of support and resistance are we dealing with, and how fresh is that? These are all questions which define what the chart would look like. And if we're going to stalk the stock, to use that terminology, if we know exactly what we're looking for, it makes life so much easier. And if you start getting good at scanning for stocks, you can be exactly specific about what you want. So nothing but the perfect hand. So quality, not quantity of trades is what I'm getting at. And most people don't have that. Most people do not have an exact strategy. And of course, if you don't know where you're going, any road will take you there. And you'll just end up trading the best of what you could find that day. So let me give you an example of this. One of the first things, I'm just going to bring up my chart. One of the first things that I would, suggest to people is stop reacting to the market. Stop reacting to the market and looking at a stock like Apple or IBM or Cisco or whatever the commonly traded stocks are. Yes, a stock needs volume. I get that, especially if you're day trading it. But if you're technically trading, the name of the stock shouldn't matter. What should matter is whether it's a high probability trade or not. But unfortunately, what most people do is they like to trade Apple or whatever because it's just what they're used to, or they feel safe because they have an iPhone and they know the company, whatever the case might be. My argument would be that there are over a 12-month period, if you're a swing trader, there's only going to be maybe 3 or 4 opportunities in that entire year where you get a really high probability trade. Okay? So when I look at a stock, I don't look at it and say, well, if I had to buy it today, would I go long or short, and where would I sell it? That's the wrong question. What I should be asking is, when I look at this chart, where would I even be interested in buying it at? So let me throw this out to the audience. Where do you think, looking at this, if we were to just bide our time, if we were to go and put an order in right now into our brokerage account, you know, a good till cancelled, so it can sit there for a year waiting to be executed, where do you think the best place on this chart would be to buy? What price? Okay, few ideas. 95, 84. All right, cool. Above 100. So you're looking for the momentum breakout. Okay. Now these are all valid answers, but I'm going to explain to you how I would determine what I think the right answer would be, because this is where probability comes into play. Think of poker. Why do you think that out of hundreds of thousands of people that play poker, that try and get to the World Series, out of those hundreds of thousands, why is it the same people at the end of the table, the final table? Because they understand probability. They know what the highest probability hands are. They know what the risk-reward ratios are like. And with stocks, it's the same thing. If a poker player could only play when he got dealt 2 aces, of course he would. But the problem is you have to pay blinds. You have to pay to see what cards you have in front of you before you make the decision. So there's a fee involved. But stocks, you don't. You don't have to pay a single cent to look at that chart and know what type of hand you have. And the hand is the pattern and whether it's at that high probability trade point. So the other beauty of the stock market is there's thousands of hands every single day being dealt that you can choose from. The trick is, A, you need to know what the high probability hands are, and B, you need to know how to find them. So let's go back to our little slide deck here. All right, so let's ask some questions, some basic questions. Who controls the market? Well, let's not put a name to it yet. Volume controls the market. So 30 years ago, volume came from investors, from the geologists, people who like mining companies. They knew the management, they liked the economy. They'd ring their broker, they'd do some research, they'd listen to the TV and listen to the radio. So watch the TV and listen to the radio, and they'd form an opinion, do their research. Maybe by the end of the week or two, they own the stock, and they hold it for a couple of years. So volume came from a value-based decision-making process. But who dictates the volume now? Well, these days, it's algorithms. It's got nothing to do with me or you. And if you are reading the paper, the algorithms have already done it within split seconds of it even being printed. So you've got no edge trying to compete, or you've got a very little edge and an uphill battle if you're trying to compete on a fundamental basis and beat them to the buy. Because 70 to 80% of the trades all come from computers making decisions based on rules. Rules that have been programmed in weeks, months, if not years ago, that if this price is hit, buy. If this price is hit, sell, and continue doing it within a certain pattern. And billions of dollars are made doing it. Billions and billions and billions. It's why the rich get richer and the poor get poorer, because again, they're making all their money off all the people losing. And we can't deny their power. They are so powerful. These rules are so powerful that they were able to make the entire market drop to a level which would normally take 3 months of growth. It dropped in minutes not just dropped in minutes, but then hit some kind of magical level where everyone bought it back and sent it straight back to where it came from. Okay? That's because of algorithms. It wasn't someone pushed the big B button instead of the M button. That's garbage. What happened was support was broken with a certain level of volume. It caused such a level of momentum of trading that the market continued to break support until it found where the smart money support level was at 1065.79. So, wouldn't it be valuable to figure out where these types of levels are? Because even though the flash crash happened back in 2010, support levels like this exist on almost every stock. And drops and recoveries like this happen all the time. So why not try and focus on how to figure out what these rules are that make these algorithms work? Now, I don't mean beat them, because I'm not going to try and outsmart Goldman Sachs. That would be a silly thing to do. But what I am going to do is realize that anything that does the same thing over and over and over again, millions of times over the decade, that follows the same rules, can be reverse engineered. Okay? The problem is that there's 60 plus patterns. So people get confused and they think, oh, the market's chaos because, well, as soon as I see the pattern, all of a sudden it changes and then it's doing something completely different. I've got no idea what the hell that is. Then it changes again. Well, this is difficult. Right, because basically that's how the market keeps you on your toes. The pattern will start to be created, and as soon as it starts to become too obvious, it'll change. So the way they keep the market on their toes, and from anyone consistently making money, is that a stock or the market is constantly cycling through those 60-odd patterns. Much like a football coach would have his team play in a football game. They're not going to play the same play. They're going to change it up again and again and again so that hopefully the other team doesn't know what to expect. But if instead of trying to look at a chart and trade it every single day, that would require you know all 60 patterns intimately, because you'd need to recognize and know how to trade all 60 patterns depending on which one the stock's in at a given point. Rather than do that, I prefer to look at what are the highest probability and highest profitability patterns and only trade stocks that have those. So I don't care what stock it is, I care what pattern it is. And so for the last 12 years, the majority of my research is purely focused on simply identifying what the common characteristics are of those trades that do the best, and also identifying what the characteristics are of the ones that don't, so we can avoid those bad trades. The first step in doing that and identifying a pattern comes back to my earlier statement. A stock will not change direction unless it hits one of the three things. So when you bring up a chart, any chart, you figure out what's going on. So if we want to look at Nike, we have to determine what type of personality the stock is in so that we can know how to trade it. So we go back and have a look at, say, October on. What was the stock doing? Well, the entire period from here right up to the peak. How many times, let's make this a little bit, let me take some of these other averages off just to clean the chart up a little bit. Okay. How many times can you see the stock break through its 9-day moving average? And the 9-day moving average is this black line here, the second black line. So the 5 and the 9 are what's basically what's holding the stock up. How many times does it touch those lines? Almost every single day. How many times does it ever break through the 9? Never. Not until the pattern changed which was exactly when you would have wanted to have gotten out. Because once it changed, well, now it became an oscillating pattern. Now the moving averages didn't matter at all. They were completely useless. What the system of control now was the extremes, not the underlying moving mountain of support beneath it, but the two extremes on either side of the stock that won't let it get past. And after it tested it enough times, it then followed the rules of a downward channel, which is that typically a downward channel will break to the upside. So as soon as we identify that we've shifted patterns and identify that a new pattern now through support and resistance that we have a downward channel, we're just simply waiting for the break, and there's some easy money. And that's what you do with every stock. You're basically looking for which of these three things are being respected, draw it on, and if you've drawn the lines on properly, you'll be left with a shape, a triangle, a diamond, a piece of pizza pointing upwards, whatever. You'll be left with a shape, and depending on the shape, that tells you how to trade it. Because algorithms don't see this, they see this. They see. Same with a flash crash. So when looking at a stock, when I asked you earlier about Nike, about where would the best price be, there's three things you want to look at to find the strongest levels if we're dealing with an oscillating trade. And remember, it's if we're dealing with an oscillating trade. So rule one is, firstly, remember what we're trying to reverse engineer. We're trying to reverse engineer smart money. Because if you see a stock, I'll give you an analogy. I love analogies. Sorry if everybody hates them, but I like to talk in analogies. Think about a 100-ton truck going 100 miles an hour down a highway, and somehow it came to a complete stop and instantly went back in the opposite direction at the exact same speed. That would be amazing and really impossible in terms of physics. So what if you saw that happen with a stock? What if a stock trading hundreds of millions of dollars a day was dropped 20%, then came to an instant stop with no news and went straight back up the opposite direction, 10-20%? That is, and if it happened instantly, that's not people. The only way you can have that kind of power is if you represent huge volume. And guess who represents that? High frequency trading. They represent 80% of the market. So if they all decide to buy and turn those lights from red to green, it doesn't matter what the company does. That stock's going up. All right? So what do we want to see when we're looking at oscillation? Well, we want to see a really aggressive, impressive drop. We want to see that thing's just plummeted. Then we want to see that it hits some magic floor and went straight back up. So we want to see a powerful and aggressive level. We don't want to see something like this. That's different. Still something we could trade, but it is not oscillation. That's retail, that's accumulation, that's investors. It's different. If we're going to reverse engineer the high frequency guys and girls, we want that. Now, the other thing, apart from being powerful, is we also want to consider how many times this has happened. So, question to the audience. Do you want to see that a stock has bounced more or less times when you enter it after finding that support? So let me make that really easy. Would you buy at A? Would you buy at B? Or more? Interesting. Yep. And the best thing about this question, I ask it almost in every webinar, is it's never does everybody agree. It's actually less. The best time to buy this is A. And this is exactly what the smart money wants you to think. Because most people think logically. because we're all intelligent people, and we think, well, if I went to a horse race and I saw that, the horse had won 5 out of 5 of its last races, then surely I'd bet on the one that keeps winning. It doesn't work like that in support. As soon as the support's been 2 times, everyone else sees that too. What does that mean? It means that everyone else now feels good about buying at that price because it's supported it so many times before. The smart money then looks at that and says, look at how many people feel confident buying at that price. Therefore, creating the ideal opportunity for the position, short the stock, and send it right back down to another level. If you look at any real pattern, look at ascending triangles, rising wedges, channel breakouts, you'll see that the rule of 3 is paramount. We go over to a stock like Budweiser, be another one that we picked as along. Have a look. It's the rule of 3. After 3 touches, most of the time that support will no longer work. So 1 touch, 2 touch, 3 touch, pull back, break. Go and do the homework on that. Look at any stock where you see ascending triangles and things like that, and you'll see that the rule of 3 works really, really well. So if support or resistance has been tested 3 times, I don't even see it anymore. I'll be looking at then as a breakout potential. All right, so we're this is normally like an hour-and-a-half presentation, but we've only got a few minutes left. So I'm going to shorten it up a bit and move on to the momentum. So basically, summary of oscillation: extremes are the ones that matter. Moving averages don't. We're more concerned with the static levels. There's your checklist, and that's what we just discussed. Okay, so therefore, examples. Here's a perfect oscillator stock, perfect oscillating levels, just bouncing exactly off this same point. 30 million bucks a day, sending it from 26.50 to 32 bucks, and lo and behold, 8 months later in the year, it does exactly the same thing. And these are the kind of things where I would just have a buy already programmed in to the stock. Momentum, completely different. Momentum, we look for moving average. Here's an example where the moving averages are what we want. And finally, the last thing that we look at is the smart money. Now, the smart money is where we look at if there's real buying going on. Are they really buying it? And the true definition of an uptrend, what do you say? What's an uptrend? Everyone always says the same answer. 1, because higher highs and higher lows, fine. But if the range was contracting, absolutely not. If the range was contracting, the volume was dropping, absolutely not. So if you're uptrend, it needs to have higher highs and higher lows. It needs to have higher volume. It needs to have higher close. It needs a lot of things. Okay, so we have indicators that actually summarize all of that into one indicator to tell you all of those happening, rather than having stochastics, directional movement, non-bound volume, and ease of movement. And all of that money is really behind it. And that's all about efficiency. Efficiency is not about making trading a job. Efficiency is about making your money work for you. And so to to kind of bring this to a close, we've got about a minute or two left. Once you've kind of defined all this, you can scan for it, and you can do awesome. If anyone has been following YouTube, we haven't had, I don't think we've had a single loser that we've picked in the last 2 weeks, and the average performance of those have been anywhere from 8% in 2 days to 30–40% in a week, and it's all based on the exact same strategy. So, if you want to learn more, and you want to learn how the smart money really works and how to build these, this is an awesome course that we've just launched in December. We've been teaching for 7 years. It's the first time we've ever released something like this, and it's 5 modules long. It's not $97 per module. It's $97 for everything. The first module goes on from what we've talked about today. So today is an introduction to Module 1. Module 2 is where we start getting into the smart money, how you can know whether you're buying a stock that the smart money is selling to you, or whether you're actually buying a stock that the smart money's been loading up on for the last few weeks. That is immensely valuable and one of the most important things I do on every single trade. The DNA and the blueprint of the market, talking about money flow, divergence, not just looking at what an indicator says today, but how does it compare to what it said a week ago and the week before that, and so forth. Divergence, money flow, smart money, looking at how to read candles, and not give them fancy names like shooting stars and hammers and three crows. Yeah, that's all great, but I probably forgot half of that years ago. What matters to me is the fact that I could look at a chart and I can see exactly what's happening with where the money's going. And whatever special term that candlestick pattern is, I'll know how to trade it because I understand the blueprint. We will teach you the fancy names though, just for everyone who wants to learn them. That's Module 4. And then Module 5 is my absolute favorite, because once we've got you to a point through the first modules where you know a really solid understanding of what the market fundamentally works on, this is when we teach you how to actually find those high probability trades. And I'll teach you the scan that I use every single day to find stocks like what I was showing you before, those oscillating patterns where where there's a high probability that there's just a lot of money just waiting to kick in. We'll teach you how to do that. We'll give you the formula. It's pre-programmed automatically already into about 5 different programs like Incredible Charts, Think or Swim, TC2000, Metastock, and if you want to use it in yours, we'll give you the code and show you how to plug it into things like TradeStation and so forth. And then we'll also teach you how to actually design your own scans if you have a really cool idea but never really knew how to execute it. So this is where you make trading fun. So I'll skip through this. We are at the end of our time. We won't be able to really answer too many questions, but if you do have questions, you can email them in or call. One of the best things about this is everyone gets their own coach. So all the modules you get immediately on demand, so you can start going through them straight away. I would highly recommend you start watching them before Monday, because at Monday a key event occurs in the market that is one of the highest probability opportunities to trade. So if you are if you're already trading and you're eager to kind of make the most of the next month, there's huge opportunities coming on Monday, which will start trading on Tuesday. And if you go through these videos by then, you should be really well set up. If you have any questions at all, everyone gets their own one-on-one coach that you can call at any time, ask questions, and make sure that you really understood it. So that brings me to the end of the presentation. I certainly hope you've found the time valuable, and we'd love to have you as part of the group. And if you do have more questions, please email them in to info@acronwealthcorp.com, or just give us a buzz.